Before you skip this video, I want to tell you why U.S. Treasury bonds are important. Let's get into it. Now, what is a U.S. Treasury bond, aka T-note, aka T-bonds? So it's essentially an IOU and or the government's way of asking for a loan. So instead of them going the traditional route and asking from a bank, what they do is, which is something so intelligent, they host something called a bond auction, where they pretty much set the standard and or set the table as to how they would like to give back on their bond and or their loan. So let's go a little bit further. So let's say I'm the US government and I'm looking for $3 million. So we gonna keep it at basic math. I'm looking for $3 million. I have 10 bonds. Now each bond is gonna be $300,000, and the return rate for each bond is gonna be 10%. So if you purchase one bond at $300,000 at the end of the year for the 10%, you're gonna get $30,000. Now that's not exactly how their pay scale may go, but it's just for the example. Now let's get into how the US Treasury bonds affect the economy. So bonds affect interest rates. So that goes with mortgages, car loans, your credit cards. So when the interest rates are rising on those, no one wants to purchase a home, no one wants to swipe a credit card, and no one wants to buy a car. If interest rates rise, then that means no one is spending. If no one is spending, then that means there's a slowdown in the economy. This is an investor's world. So if the US government offers a greater return on your money through bonds, then that means many investors will slow down in equities, meaning stocks. That's all equities are, stocks. So many investors would transition over from stocks over into the bond market and or close some positions to be able to transition the money over into the bond market to be able to have that greater return on their money. And that is how the bond market affects the US economy. Be sure to like, comment, and also follow for more content. Y'all stay tuned.